Hey guys, welcome back to the Capital Mindset Show. I got a special one for you here today. If you're a goldfish, it's going to be really hard, to keep through the whole video, but I promise you, if you stick to the end, you'll find some value in it. So this video is going to be focused on 3 different companies, actually what they share in common, and a 4th company, actually, technically speaking. They share one thing in common, that is giving a monthly dividend. So on YouTube, there's plenty of videos out there talking about making some passive income as well as some monthly dividend stocks. I want to highlight that if you guys are followers of this channel, you know that we don't really talk about that or highlight that as a selling point for a particular company. We shouldn't really care too much about the amount that they pay or in the frequency that they pay. It really matters more on the fundamentals of said business, but we're going to do so. These 4 companies have been requested by the subscriber. These are all subscriber requests, and one of them was coming up due, and I decided, you know what, I'm going to do all of these at the same time because they have something in common, which is the monthly dividend, as you can see per the thumbnail. So if you're newer to the channel and you clicked on this because you saw monthly dividend income, shame on you a little bit, but hopefully over this course of this video, we actually go over all of these companies so you can get a feel for the valuation prospects of these companies and an appreciation for REITs. So some of this I'm going to actually start to begin with understanding what it is that we're going to focus on with a REIT. So let's first discuss very simply what is a REIT. So REIT, R-E-I-T, stands for Real Estate Investment Trust. Okay, Real Estate Investment Trust. What these are pass-through entities. So a pass-through entity, what it basically insinuates, and I'll actually remove myself from the screen here so you guys don't have to get distracted by me. What we want to focus on with a pass-through entity is that we, as the investor, so the investor, or you, I'll just say you pay the tax. So you pay the tax. The REIT does not pay the tax. Does not pay the tax. It actually does not pay any taxes whatsoever on its income. Okay, it's a pass-through entity, which means all of the income actually, in fact, goes to you, the owner. So when we look at the historical return average of REITs, you might have heard that REITs have been the best performing index out there, right? As the best performing asset class out there by measure. Now, this is actually because a lot of those measures don't take into account tax. So if you allow taxes to keep growing, so you have the income, and then the income is in theory reinvested, and you get more income, okay? We call this the compounding effect, right? And with normal taxation, you have the corporate taxes, which sits at around 21% as of now. So 21% of the income is taken out and goes to the government, okay? So G-O-V-T, okay, so the government. But if you don't have this component and all the money is able to be reinvested, in theory, you should have a favorable mathematical outcome. Okay, so that's in theory. Now, in reality, it turns out this is true. Okay, so, but if you consider the taxation, which I'll actually get into in a sec, taxation as a REIT is actually taxed as ordinary income. So ordinary income. Okay, generally speaking, a dividend from a REIT is taxed at ordinary income instead of preferred. Okay, so a preferred tax basis on a lower long-term capital gains tax rate. You can be taxed at your ordinary income, which is at your highest income threshold. Okay, so one thing to note is that you might be thinking, okay, retirement accounts can shield this income from incoming taxation. So instead, you don't get this tax. So they're not able to tax here, right? Because it's protected inside of a retirement account. Personally, for me, that's how I handle it. I invest all of my REITs in a tax advantage account. Currently, you might know if you've been following this channel for quite some time, I don't hold any REITs. Those were one of the sales we did earlier on at the end of 2022, early 2021, in anticipation for the liquidity crunch. So a little bit change in strategy. And so my favorite, we're actually going to go over my favorite REIT of all time. It's actually included in this video, but we'll get to that. And actually, 2 of them are really my favorites. But the first one we're going to be discussing is Stag Industrial. And I'll actually pull up that one for us here right now. So Stag Industrial actually traded up 2.47% today. If I actually pull it over here and show you guys the dividend yield is about 4.69%. You can see that over my shoulder. The market cap is sitting at about 5.58 billion US dollars. It is small enough. This is a smaller player. So in REITs, we have to you can find a REIT on anything. Okay, let me just tell you that right now. You can find a REIT on any type of property that you could even think of. You can find one on billboards. You can find one on industrial spaces. You can find one on, anything, really anything, cell towers even. So when you look at something like Stag Industrial, we can kind of picture out what kind of property this is. So this is an industrial property. So Stag, right, they find an industrial property and they rent it. So we'll just go prop for property, and they find a tenant, right? I'll just put tenant. So they collect rent, simply put. And you basically are the owner of this entity. Again, reiterating, it's a pass-through entity. So you own Stag Industrial. Stag Industrial owns property, and this would be prop. And then property goes to tenant. Tenant uses the property. Tenant pays Stag Industrial rent. All right, simple enough, right? So what Stag Industrial is, and what actually these three entities are, is they're known as triple net lease. Okay, you might hear this term a lot. Triple net lease, three N's. NNN. Triple net lease essentially means the liabilities, to a large extension, to actually the vast majority of it, extend to the tenant. So the tenant pays all of the liabilities, like maintenance, property taxes, etc. And so when you hear triple net lease, you got to think, what do I do as the owner? I just collect the rent checks. So rent checks flow to the owner. And this is nice because a lot less need for employees. If you actually see the employee base for these companies, you'll be quite surprised. And in fact, Stag Industrial, a $3 billion company, if you had to guess how many employees you had, you would probably guess wrong initially. But if you know this, they have 86 employees. So they have 86 employees for a $3 billion business. And if we actually show you one of the, well, we'll talk about that when we see Realty Income, but we'll show you with the other companies too. So what are some of the advantages versus disadvantages of a REIT? Well, some people point to the leverage. So with leverage allows you to take on extra amounts of risk for an extra amount of return. So we take on leverage for private property. And in that sense, what are some of the benefits? Well, we have a fixed rate, right? And we don't do that with stocks. We get margin, but it's not a fixed rate. And it's non-callable. All right, so non-callable. This is very important, which basically means that the actual bank cannot tell you when you have to pay it back immediately, right? You can extend it for 30 years, right? You might have heard we have a 30 years mortgage, right? So 30-year mortgage, as an example, or you might be able to issue some bonds for an extended period of time. So these are things that are some advantages for private real estate that we don't get with stocks, okay? However, what if I told you you're thinking about it the wrong way? Well, you own the REIT. So you own the REIT, and the REIT borrows and then slash leverage, all right? So the REIT borrows on your behalf, and through this, it gets property. So you could say RE, real estate, it gets real estate, and then with this real estate, it gets a tenant. Okay, so tenant, so I'll put 10 for tenants. So in that kind of same network, you're still getting the same effects. And through there, you still get the returns. And remember, what is a REIT? A REIT is a pass-through entity, so it doesn't pay any of the taxes. Now, what are the rules that a REIT has to follow? It has to follow several, but I'll explain some of them. And this is the key word. It must pay 90% of its taxable income, okay, to the shareholder. Taxable income. And this is the key word. A lot of you accountants are going, oh, I already know where this is going. Taxable income to the shareholder, which is you. Okay, so this is you. You're getting 90% of the taxable income. Well, let's not hide the fact that, okay, well, taxable income, when we get to some of the balance sheet and income statements, I'll actually highlight that for you guys there as to why it's important to, keep note of that. So with that being said, what are some of the other rules? Well, there's a limitation on the amount of owners that can be in a REIT. So just for an example, I'll just pull this up here. If we take a look again at Stag Industrial, Stag Industrial's, a decently sized company. We have what's called, for such a big company, regardless of the size, the 550 test. So 550. What this basically means is no 5 owners can own together more than 50% of the REIT. So not only do we have to pay out 90% of taxable income, no more than 5 owners can own more than 50% of the REIT, okay? Simple enough. So if you follow those two, you're good to go. And you have to make your income from real estate. Okay, that's another thing, obvious. So when we discuss rental properties, let's discuss the specificities of Stag Industrial. Stag Industrial owns industrial properties. As of late, Stag Industrial or industrial properties have been very hot. So depending on what industry you're in, for example, self-storage facilities were not that attractive in the past. Now they're very attractive. Industrial properties have been very attractive. With real estate, you want to focus on a couple key tenants. So, and when I mean tenants, not like the tenants, but like some rules here. So you want good land. Land's very important. Location. So LLL. This is very important. Okay. And with that, you also have the tenant quality. So tenant quality, we can have investment grade. Investment grade is BBB. Remember this for later. And BBB and above. So anything above BBB is considered investment grade. Anything below BBB is considered non-investment grade. We'll talk about the benefits when we get to that REIT in particular. But what are some of the difficulties with industrial properties? Well, we've seen Amazon report. What did Amazon say when they reported? We overbuilt. Okay, so that's a little bit of a problem. So supply, right? So supply is a constraint. And remember, if you're dealing with your property type, if it's overbuilt, we're going to have a problem. So we saw in the commercial use space for, not for malls, for example. Okay, so malls were overbuilt in the United States, and we're still going through it, where there's plenty of real estate and not all of it's good. So I've talked about this when you guys have asked me about Simon Property Group, ticker symbol SPG, and Simon Property Group owns a lot of A properties. Okay, so there's A properties, B properties, C properties, for example. This obviously best, second best, third best. So A, typically you might want to think of new, better location, okay, stuff like that. And B is going to be slightly worse, but not as bad as C, and it kind of gets worse and worse and worse. We're going to, again, discuss that when we get to one particular REIT, but you got to understand that there's different grades for real estate, and that same goes with residential real estate too, and neighborhoods and stuff. So we want to pay attention to that. Now, with REITs, you want to pay attention to this metric, which we'll highlight in the financial statements, and that's FFO. So this stands for funds from operations. When I say this word, I want you to think cash flow. So cash flow. Okay, so we're going to think about this. And when I say FFO again, you're going to think cash flow. They're one and the same, practically speaking. Okay, and again, you probably pieced it together, some of you, about taxable income and cash flows, but we'll get to that. So with that all being said, I want to actually go through Stag Industrial's financial statements, and we're going to go over some key details. So let's go here. Let's zoom it in for you guys who are watching on mobile and also on computer, because I know it's kind of zoomed out. So we're going to go to the financial statements, and we're going to come down here. So let's see the balance sheet right here. So I want to highlight some key parts that are very important to understand. Land. Okay, so what is this land thing? So we talked about land. Land is something where you build the property on. Obviously, land is a non-depreciable asset. You cannot depreciate land. Land cannot be depreciated. Buildings, however, can, and improvements, by the way, and improvements on those buildings can be depreciated. It's not an accounting lecture, but you can kind of get that. I think it's important for the conversation here at hand. So you can kind of see they tell you the depreciation levels. They had $611 million depreciation in 2021, $495 in 2020, and when we see it in the next side, deferred leasing intangibles amortization. So amortization is equal to depreciation. I want you to think about it that way. It's basically the same thing, except it's done for an intangible asset. So we often say depreciation and amortization. We say those two together. So total rental property net, so it's after that depreciation effect and amortization effect, that is a total value. So that's basically the book value. So in accounting, we say the book value or the market value. Those are two separate things. The book value of accounting, this is by the way, GAAP, not necessarily the taxes. It's not the tax book value, but it's the GAAP book value. So here, we're going to say that's basically our cost basis for the property. So if we were to sell it, our technical value is 5.620. We do have depreciation recapture. We won't get into that, but that's something you do have to consider. Cash and cash equivalents, restricted cash, all that's well and good, but kind of swapping over, I want you to pay attention to that $5.6 billion. Go down to the liability section. You're going to see mortgages, unsecured notes, unsecured term loans, unsecured credit facility. These are all debt instruments that kind of match up with that asset base up top. Right, that 5.6 billion. What you should notice here, if you add up all the liabilities, not even the ones referring to the actual debt obligations, it's 2.4 billion versus a book value of 5.6 billion. So there's a very good amount of leverage being used here, as in not much at all. So there's a lot of equity in the business. And you go down to the total equity side, you actually see a decent amount of equity. So this is kind of not some rough math, but that's a rough way of thinking about it. The assets minus liabilities always equals equity. And so again, if you can also think about it, equity plus liabilities equals assets, right? Typical, very basic finance 101. So financial accounting, you should have learned that. So with that being said, I kind of want to highlight, okay, where did the rest of the money come from in order to get the property, right? You can't just take on that much debt and get that much property. Well, it comes from somewhere, and we'll discuss that when we get to the statement of cash flows. We go down to the income statement. In the income statement, we're going to see rental revenue, other income, and total revenue. Okay, let's go down to the expenses, property, general and administrative, depreciation, amortization. Look where that came from. So let's go back down here, and let's go here. You can see they depreciated 600 and amortized 282. What do we see here when we see depreciation and amortization for the total year? We see the totality of that. Why are they different? Let's go back to the wording here, and it's accumulated. Okay, so not to be confused. Accumulated depreciation means in totality, thus far as the property has existed within the financial statement. So in totality, if we bought it 10 years ago, we have a number called accumulative depreciation, which is the totality of the depreciation since that 10 years that we've owned it. Going down again, back to statement of, income statement, almost said statement of cash flows. We see general administrative and depreciation amortization line item. That's the totality of this year. Okay, so we're going to add this back eventually because that's not a cash expense. So let's go back to the whiteboard and kind of understand this. So depreciation, I'll label that as DEP, is a non-cash expense. Okay, that's what you need to remember. Depreciation is a non-cash expense. Amortization is a non-cash expense. However, it is a real expense. I want everyone to not think that it's not a real expense. Depreciation in accounting is a representation of an expense, okay? It represents, literally, as the word implies, the depreciation of the property. Even though the market value may be going up, right, the actual structure integrity of said building does go down. Things don't rejuvenate themselves naturally. They degrade over time. Time is the great degrader of everything, and depreciation is a representation of that degradation over time. So it's a real expense. People really make a mistake in saying it's not a real expense. No, it's a real expense. And so when we look at the total expenses, very manageable, down to the net income. So I'm going to highlight the net income. Net income is $196 million. Well, let's hop on over down to the statement of cash flows. Statement of cash flows, and we are seeing a total net income of $196.4 million. Okay, let's go down to see where the dividends. So dividends and distributions, $245. Okay, so traditionally speaking, people say, oh, dividend payout, so a payout of greater than 100% is bad, or sad face. Say, oh, that's a weird sad face. Let's improve that sad face. Boom, boom, and then sad face. Okay, so nice and sad face. So if you have a payout ratio greater than 100%, generally speaking, that's bad. Okay, with a REIT, you can't think of it that way. Although the principle is true, a payout ratio of greater than 100% is technically correct. What you have to focus on is cash flows, or FFO. Remember, I told you FFO equals cash flows. So FFO, you want the FFO payout ratio to be less than 100%. Okay? Less than 100%, this is ideal. Now, another key metric that we're going to focus on, I'll introduce it to you now, is something called FFO per share. So FFO per share. Okay, very important. So we can do this by calculating the FFO divided by the shares. Very simple formula. It's just a ratio. So if you calculate this, you want to actually pay attention to this. Right? You want to make sure that that is growing over long periods of time. And we're going to actually discuss that in a second when we get back to the statement of cash flows, because there is an important line item that you want to actually see. And that is the, trying to find it with my eyes. Yes, here it is. Proceeds and sale from common stock. All right, right here. So this is the amount of cash that they generate from the issuance of common stock. And you might be hearing from, some other YouTubers that's saying dilution is the silent killer, blah, 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 blah. And while, yes, generally speaking, on a broad basis, you can assume that. You don't want to assume that with REITs. REITs are a whole other animal. So if you look at REITs, they're mostly all going to be very dilutive. So very dilutive, typically. All right, and then don't worry about that. It's disgusting anyway. What we want to actually focus on is the amount of shares going up, but we want to make sure that the FFO per share is rising. What this means is it's accretive. What it means that each time they issue it, it's better. So what we are going to pay attention to for most entities is that they're going to invest in something that is accretive. So for example, we're going to look at a example of, let's say the dividend yield is 3%. And that's the cost of the equity, as an example, cost of equity. We're going to keep it simple. And you find a property that yields 6%. Well, if you find this, then the delta is equal to 3%, because that's 6 minus 3 is equal to 3, right? And so that's your 3 over here. So that's your delta, right? So if you find a deal like this, you're going to take it every day of the week because it's going to be accretive to shareholders. And if you know, let's say, assume that this is a fact, assume that that is exactly what's going to happen. You are for sure going to get 6%, which not really is always the case. You know that you're going to get 3% in terms of cost because you're going to issue the shares at 3% cost. But let's say you find one that will 100% yield 6%. Well, if that's the case, absolutely every single day of the week, take this deal. Take this deal because you're going to increase the total percentage by 3%. So that's amazing, right? That's a good deal. You're going to take that every day of the week, and you're going to do that analysis. We do that analysis at work. So if we do, for example, we find a property, and we found properties in the past where, let's say, just to make up some numbers, our cost of capital again is 5%, and the cap rate is, let's say 10%. All right, we're going to take that every step of the way. All right, and by the way, I don't want to just get ahead of myself here, but cap rate, so cap rate in real estate is very simple. It just means the NOI, or just think of this as rent divided by purchase price. So purchase. All right, very simple. All right, very simple formula. So cap rate is equal to NOI, or rent. You want to know it as rent. This is technically the technical term in real estate. You would use that word NOI. But for you guys, this is a stock channel. We're not doing like commercial real estate or anything like that. So we're going to be talking about it from that context. So rent, just keep it like that. Now, when you see cap rates, every property type has a different level of cap rate, right? For the most recent time being, I think industrial properties, depending on where you look, the cap rates are pretty low. You might see 6%, 7%, 5% in some extreme cases. Other property types will have lower cap rates. Other property types will have higher cap rates. Hotels tend to have higher cap rates, for example. They're not as attractive right now, especially. Offices tend to have higher cap rates depending on where it's located. And then again, remember that grading system, A, B, C, D, right? So this has the lowest cap rate. And I'll explain to you guys the importance of these cap rates when we get to the third company. But sticking to Stag Industrial, let's kind of revert back here because I don't want to give you guys everything all at once, kind of separate it there. Repurchase of retirement share-based compensation, so you're not going to see that much. Again, it's going to be a negative amount there, but it's not going to be as much as this. You're going to see them as being a net diluters. You can also see their proceeds from a secured credit facility. So they got more credit here. They're purchasing assets and they're growing the asset base. Okay, so with that being said, we're going to move over to the actual evaluation model. Let me actually zoom in for you guys who are on mobile. I don't think that's enough. I think I need to do one more. Okay, so I already actually have it indicated to the model that it's a REIT, because the model can already do this for us, where it basically just automatically calculates what it is that we need to look at. So we indicate to it, yes, we're looking at a REIT, and we're going to start off with Stag Industrial. Okay, so Stag Industrial, it's going to plug in. Give it a second. It's going to wake up. But yeah, there's another company called Prologis, which is the bigger brother of Stag Industrial. Stag Industrial is a smaller company. Okay, there you go. You got the $5.58 billion market cap, strong buy according to analysts, and a $41 price target, implying a 34.27% upside. So I want to highlight some things for you. Remember that this company is going to be very dilutive over time. You can see that dilution rate of about 13.85%. If I take you down to the revenue, this is the rent for all intents and purposes. It is rising and is actually estimated to come down a little bit. Remember that under the context of what we discussed, something like Amazon reported that they've overbuilt. There's a lot of industrial properties right now. However, cash flows are actually expected to rise substantially. This can come from the efforts of acquiring new properties over time. Shares outstanding, they will continue to rise over time. And again, this, I'm not so sure on the revenue, why they're actually estimating a decline, but we'll see. So on that note, or on that front, we're going to kind of analyze this from the perspective of look at the growth at 94.53%. Remember that that's going to be tamed by the fact that, one, they're going to be diluting a lot, and two, it's actually pretty possible because they're operating from such a small base, they can take on a lot of leverage, they can issue a lot of shares, and they can buy up a ton of properties. The cash flows can actually increase by about 90-ish%. It can actually happen, but I wouldn't actually expect 94% continually. What I do think is that the market might be pricing this company in for about, about 30-ish% growth rates, or a little bit less than that. And if we actually want a little bit of a greater margin of safety, I'll actually showcase to you what you do have to expect. So I think at 35%, you most definitely can. And maybe that's what analysts are expecting. Again, it looks like it's a lot of growth, but remember, please remember that we are in fact including the dilution into the calculation. So when we do count that in, we do see that, oh yes, it's not like, oh, it's 35% with no cost. Because what you as the investor have to pay attention to, and this is what we're basically calculating, is again that FFO per share. So that FFO per share is the thing that you need to be measuring to see if it's going up. If it's not going up, management's doing a disservice by you. So that's a bit of a problem. So just keep that in mind. And so when we look at REITs like this, we're going to be paying attention to that for the most part. So going forward, I think that this company, again, is very well capitalized, no risk of bankruptcy, even despite that the fact that the model is actually saying, it's I don't know. And, that payout ratio, I'm not really going to be paying attention to because, again, on a cash flow basis, they can cover it. Which is something maybe I should, let me show you guys real quick on the balance sheet or the statement of cash flow. So remember that with this company, we want to see the dividend payment, which is, where'd you go again? Dividends, right? So 245, cash flows of 336. We are good to go. We're fine. So we don't really care about that. And then so from that, I kind of say Stag Industrial looks like an interesting business. However, I'd be a little bit cautious maybe that the industry kind of overbuilt, and that could be a problem for much time to come. So keep an eye out for that. That'd be a concern I would have. Now, the next company that we are going to be discussing is Realty Income. I've talked about this company in the past. It is my favorite REIT, or one of my favorite REITs, and has a dividend yield of about 4.57%, market cap of $38.98 billion. And if you had to guess, what would you say is the employee count? And I'll let you guys just guess. The answer is 369. So again, that triple net lease kind of shining out and saying, well, if we're triple net, we don't have much liabilities or much in the way of what we have to manage. We just have to collect those rent checks. So we only need about 369 employees. We're a really light business model. Okay, so that's really nice. One thing I'll note about REITs, and actually REITs or insiders in the industry can actually tell you this or attest to this, and if you're one of them, please share in the comments down below, that the industry is actually full of lawyers. A lot of REITs are just chock full of lawyers for whatever reason that might be. But yes, this company is also known as kind of like the creme de la creme of REITs. So it's known to be one of the best performing REITs. If you had bought this company and reinvested the dividends since IPO, you have done fantastic for yourself. Let me just tell you that 676% growth does not do it justice, because if you had compounded those dividends in a retirement account, you would have been very wealthy. You would have been very well off, and producing tons of income, by the way, on the side as well. So with that being said, we're going to actually dive into Realty Income's books, remembering some of the stuff that we've discussed. I actually will showcase for you. I think it's important that we do explore this. Let me actually go to their portfolio and show this to you. You can go on any of these REITs and they show this to you. So they've been expanding recently into Europe. Europe has some interesting cap rates. They've been borrowing in both European euros and US dollars. But for European properties, by the way, let me actually just tell you guys this. When you borrow a property, be very careful. We would never, ever do this. This would be very stupid. So borrow according to the rent. So whatever rent currency you have. So rent currency. Okay. So this is a good rule of thumb, that the borrowing should follow the rental currency, because you want to be very careful with cross currency risk. So when, let's say, you're borrowing in dollars. All right. So you borrow in dollars and then you rent in, I don't know, like yen. All right. Yen. Right. And so because you have a property in Japan, so the Japanese yen. Well, what happens if the dollar rises in value? So the dollar rises in value, so therefore the yen follows in value. This is an adverse situation. But if the opposite is true, and you have the yen rise in value and the dollar fall in value, well, yeah, you're in a good situation. So you have to manage this relationship. And oftentimes, a company would just decide, I'll just borrow and buy property and rent it in the currency that I borrowed it in. That sort of helps alleviate that part of the risk, okay? Because that's a risk that you have to consider. So taking a look down here, you can kind of see, oh yeah, their portfolio, blah, blah, blah. I'm trying to see where actually they show their footprint, but not their footprint, sorry, their tenants, because here we go. I think it's this one. So yeah, they have Walmart, or whatever. What are they actually showing me here? No, I want to see your convenience stores. I know they have a lot of convenience stores and stuff like that. They used to have, I prefer their old website. Their old website had it a little bit better. Oh, probably this part has it. All right, so this is where we have it. Grocery stores is 10%, convenience stores 9.1%, so that's like 7-Eleven, stuff like that. Dollar stores 7.4%. So basically you just walk through this and you kind of say, do I like what they're doing here? They have some industrial, 14.4%, and then you can kind of see by jurisdiction. I prefer them not to have, yeah, California is like, but California is fine. It's like cash. Well, California actually has some very favorable tax laws regarding real estate, so just so you know, okay, but they tried to repeal it. Anyways, it's pretty interesting. How much do they have in Florida? 5.3%. So they have 702 properties. I mean, this is a huge company. 6 properties in Australia. How many do they have in Spain? 43, and then the UK 151. They're growing pretty fast. Yeah, they're growing pretty fast in the UK. Wow, 8.7% of total portfolio analyzed. Wow, so that's actually crazy. They have more properties less properties in the UK, but there must be way bigger properties then. Okay, so that pretty much covers realty income from that standpoint. We're going to go over here and go to the financial statements, and we're going to go to oh, I want to highlight this. This is actually really cool. They have the actual funds from operations listed here, so you can actually go through this and be like, oh, they're doing better or worse. So let's go back here. So financial statements, consolidated. Yeah, boom. Okay, so assets. So same thing here. You're going to have your land can't be depreciated, buildings and improvements. This is what can be depreciated, total real estate, and then the depreciation, then the book value, yada, yada, yada. Going down to liabilities, you have loans and stuff that should balance out. You can kind of see total liabilities relative to the total assets of property, not even the total assets, is very good, very conservatively built out. Pretty much the same as Stag Industrial, so pretty good all the way around. Going to the statement of cash flows, you can kind of see they depreciated $677 million. If you go to the income statement, again, they have the depreciation of $677 million. And again, if you go here, I think they have the term accumulated depreciation, and you can see that the totality of the current year was $677 million. Okay, and again, you go down here, you look at the cash flows right there. You go look and see the dividends. Where's that dividend? Dividend somewhere. My eyes can't really see them right now. But anyways, dividends will be somewhere in here, and then you just compare it to there. Dividends, last time I checked, were pretty good. All right, so they're payable. Okay, they're completely payable, and cash distribution to common shareholders, found it. Boom. There we go. So it's a little bit more of a tighter squeeze, but it's doable. They're still well off. And this company, by the way, has a credit rating of A. So just so everyone understands, in credit rating stance, an A or BBB and above is investment grade. Okay, and Realty Income has a credit rating of A, or I think A minus, one of these two. So they're one of the best of the credit rating in the REIT sector, and it's very rare to actually find a REIT. So basically what that means is that they can acquire capital at a lower cost. And remember, under that same premise, remember that the cost of the said capital is what limits us. So cost of capital is what limits us in our project. So if we're looking at this from the work standpoint, if I'm looking at our cost of capital being 6%, and I see a project that can yield reasonably like 9%, I can take that project. But if I have a cost of capital of 6% and I find a project that yields 5%, I can't take that, right? And so one of the things that benefits a REIT is if they're overvalued for long periods of time. So going back to that example, let's say hypothetically, a REIT is extremely overvalued and it trades at a cost that would cost the company 2% to dilute. So a 2% cost, and another competitor has a 5% cost. Okay, so what this basically means is this REIT, they can actually take on a 3% cap rate property, but this REIT cannot take on the 3% cap rate property unless for some reason we really think that this 3% is going to grow pretty quickly, because otherwise this is going to be very dangerous. We do too many of these deals, we're not going to be in business for too long. So yeah, that's something you want to think about when you're looking at a REIT. A lot of times being expensive actually does benefit the REITs as well. It's kind of like a self-fulfilling prophecy. So let's go over to the evaluation model and let's plug in O and kind of figure out what's going on. So with Realty Income, we're probably going to see a buy rating because analysts love this one too. I don't blame them. It's a pretty awesome company. Strong buy. Price target is $70.24. We look at the dilution rate. It's going to be a lot less. They are a much bigger company, so it does make sense in my opinion. So if we actually eliminate this, I want to say that 25% is probably going to be on the higher terms of growth. They're probably only going to achieve that if they do acquisitions. And this actually should be negative because they are not buying back shares. It's dilutive. So 25% is going to be on the higher front. And if I'm being honest, right there, you can kind of see, well, it's not trading at amazing prices, but you could have gotten like that price around the pandemic level. Now, if you're looking for, you can probably say that margin safety too strong. You're pretty much there for that 25%, and that 10%, you're already there. But regarding that, you might make the argument, and I've seen some analysts kind of assume 30-ish% growth around there for FFO, but I think 25% is more well and good. On the extreme case, I think that it's more likely that they do less than that. So 20% would probably be here, and I think I had it penciled out 17%, 15%, 12%. So it would be very interesting buy at about like $59-ish, which it traded there for quite some time, by the way. And yeah, and you could still get that margin of safety there. And again, you saw this in the pandemic. In the pandemic, you actually got some of these prices. You also have to consider the fact that you could also be compounding that dividend too. So you'll get that cash injection. I would have this in a retirement account. Now you can kind of see that the growth estimation is actually quite drastic because this is the actual acquisition that's going to be measured. But remember that they did dilute by quite a bit to actually acquire that REIT. So it's two REITs kind of merged together for that new entity to form. Okay, so on that, we're going to actually move over to the last company, or last REIT, better to be said, and that's ADC. So ADC actually trades here, ticker symbol ADC, and they have a dividend yield, and you can actually see that right there, 4.09% across my shoulder. So remember, all of these companies pay monthly, so you can actually divide that by 12 and figure out your monthly income there. So if you look at the max point, it's actually only up 252%. Again, if you had thought about the dividend and recompounded over and over and over again, returns would have been much greater. Of course, the real shining of this company has been since about 2009 relative to Realty Income, where it's done 554%, and it has, again, spun out a bunch of dividend income that had someone put in a retirement account, they would have done really well. So over the long period of time, it hasn't done as well, but, again, one thing I should also note, this company is run by the family, the founding family, the Agree family, by the way. So, yes, you have that to look forward to. And we actually, let's take a look. Well, they also have 57 employees. So a $5 billion company with 57 employees. Fantastic. Let's open up to see their website. We can kind of get a feel for some of their different stuff right here. So let's see here. I don't care about that. So one thing I want to highlight is you're going to see a lot of investment grade tenants, and that's something that they kind of highlight. You see there 68% is investment grade, so nearly 70%, absolutely fantastic. And this is where I kind of get back to the whole point. Remember that investment grade tenants is BBB and above. So anything above BBB, and that's a standard credit score for companies. By the way, there's other forms, but this is the standard variation with the alphabet. And when we look at BBB and above, what we're going to get in investment grade, so investment, so inv grade, we are going to get a couple benefits. So one, less risk, right? Less risk, greater duration, hypothetically, so greater duration of rent, and something that is not good. So these are negatives. So these are pluses. And then the negatives would be lower cap rate and lower escalations. So you can't raise the rent as much on them. And another, I guess you could say, is kind of coincides with the other two, less negotiating power. So less negotiating power. Okay, so you can kind of think those are the benefits and drawbacks. There are other companies that focus on the other strategies, such as you could think of Stag Industrial, Store Realty. So Store Realty is another company, STOR. They focus on non-investment grade tenants, and they get actually a master lease agreement, which allows them to see all of the P&Ls of their tenants on a much more intimate basis, something that Agree Realty couldn't really do with their investment grade tenants because, again, they have more to command. So you can kind of think of tenants like Home Depot or Lowe's. Those are all investment grade tenants, and all of them, do fantastic, right? So if we actually go over to their financial statements, we can actually see, I want to highlight to you guys the financial statements. Where are you guys at? There it is. All right, so it took me a little bit. All right, so assets, very clean balance sheet in terms of readability. Land, buildings, less cumulative depreciation, property under development, net real estate investments, $4.3 billion. Where's that total liabilities? Let's see here, other assets, total assets. I guess they keep the liabilities over here. Yep, liabilities, mortgage payable, unsecured term loans, blah, 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 blah. What you can kind of see here is total liabilities is, again, very interestingly conservative relative to assets. I think the most conservative of the bunch, by the way. And in totality, you got a decent amount of equity here, but I think in totality, it's the most conservative. Now, let me actually zoom in on this one. So depreciation, amortization right here is about 95. And we have net income. It's coming out at 122. We're adding that back in. And we also want to find the dividends paid. So let's see that. Payments. Oh, we want to also highlight, look at that dilution again. And distributions, payment of common stock dividends. There we go. So 194 doesn't look sustainable according to net income, but on the cash flow basis, it's pretty sustainable. It's all well and good. So that's what I want to highlight for you here. And what you get benefits of this company is you get better investment grade tenants, so a lot more security in that front. And I want to highlight, remember the fact that what does an investment grade tenant typically like to look for? Well, they like to get the best land, right? And so if the purpose of a REIT or real estate is to get the best land, remember, location. If you're getting the tenants that want the best location, and then you are therefore focusing a strategy on that front, you are then probably acquiring the best properties. So that's another way to think about it. And them being small and nimble and family run basically maybe allows them to be that conservative. So this is going to be probably a slower growing, but somewhat of a more sleep well at night kind of stock, or a REIT, so to speak. This is one of my best friend's very favorite. So he loves this company. He invests regularly into this company. So if you actually take a look at the analyst estimations, they estimate it at the fair value of $65.74, implying a negative 4.31% downside. So with regarding to growth rates, they are going to probably have around the similar dilution rate of about 10-ish% going forward, and that's not the opposite of what I wanted, dilution rate. And growth rates could actually average out to, like, I think on the high end, we can see probably like 35-ish%. That's very high end and not probable. I'll explain why these are some of the risks I want to call out, and I wanted to wait to the end of this part to kind of combine them all because they all have the same risk, and it's a big risk. I'll show you in a second. But 30% is kind of like the second, but also not as probable. And in terms of the other percent growth rates, I think I penciled out like around 27. And well, technically 27.5, but I'll leave it at 27, and 25, and then 20. Okay, so smaller company, a lot more room to grow, a lot more properties out there for it to acquire. Remember, we're not really getting that margin of safety here, because if we want to get that margin of safety, you can kind of see how that really does come down, and you're basically priced not even for that 30% growth rate. So yeah, just consider that as well. And this is going to be trading pretty expensively because of the quality of their tenants, quality of their assets on the books. So. All right, so all in all, revenue is expected to kind of remain stagnant for whatever reason in cash flows. That's what analysts are estimating. Shares outstanding continue to probably rise up. And as far as sentiment goes, it is positive. So all in all, I want to actually showcase some of the risks associated with all these businesses. So one thing they have in common is that they need to acquire capital. So capital is needed. And with rates rising, so if rates rise, we also have an increase in the cost of capital. So cost for capital rises as well. So if rates rise, cost of capital rises. So you got to remember that. So if that occurs, remember that formulation that we kind of were discussing, or that scenario? Well, if your cost of capital is about like 5%, and you see a property that says, 4%, all right, you can't really take this, right? Cost of capital, so cost and then cap rate. You can't take this. Nope, not good. Now, let's say things get worse. So the cost of capital rises. Right? So if the cost of capital rises to 10%, right? Now you really can't take this. But let's say this happens to everyone. Well, then that's not good, because then, no one can get this property. So what did that mean? The demand has to come down, and the price of the property has to come down so the cap rate can go up. Because remember, what is the formula for cap rate? So for you guys, all intents and purposes, rent divided by price. So the price must come down. The rent stays the same. So if the rent stays the same and the price comes down, then you can get a cap rate. Let's say it goes to 11%. Well, now you're in business, right? As long as if it's an 11% and your cost is 10%, well, you're in business. Okay, so this is a favorable outcome, and that would be not favorable to those who are selling the property, and the market value of all of these assets will go down. We've discussed in the previous time when rates actually can go up, but REITs actually don't go down in terms of value. And that's because when we have periods of inflation, real estate can appreciate alongside that inflation. So inflation can cause the value of real assets, and I say value in nominal terms. Inflation can cause that to go up, and then relative to the liabilities tied to those assets, basically the value of those in real terms comes down. So just to reiterate, rates can be a huge negative weight on real estate. And some people out there say, you know, well, macro doesn't necessarily matter. Well, that's very nuanced. I'd say for real estate, macro does matter a lot more because they are affected by rates. Rates are a huge indicator or factor for where these companies can acquire capital. So if I was working at a REIT and we were looking at properties, the rates do matter because that affects the projects we can take on. And therefore, in aggregate, when we look at all the REITs together, if we all can't afford cap rates of 5%, well, we're not going to be bidding those properties. So guess what happens to those properties? If there's no bids and they're trying to sell it, well, the price has to come down. And that kind of becomes a circle, right? A circle swing or something. So with that being said, I also want to highlight this point to you. The case that with cap rates kind of coming down, with the cost of capital rising, we can kind of center ourselves and say, okay, well, what happened with your thoughts on the liquidity crunch, Fabio? Because you sold the stocks and you thought these REITs were going to come down. So let's actually revisit for example, this one right here. Let's see the Agree Realty. So you guys remember my video back in early, I think it was January. Where was January? Where's January? Yeah, here, January. And then I remember getting some comments saying, oh, you were right because this happened. And then I was wrong, you see? Because what happened? So I talked to one of my old professors who, she works in the industry in commercial real estate space. And she actually brought this idea to my attention, which I want to share with you guys here. I want to take the time and share it with you guys here on this notion. So if I think about it like this, right? Right now we have real estate is getting bid up and we have private players. Okay, private players. So these guys are trying to bid up this real estate. And then you have REITs, right? They're trying to bid up the real estate too. Right now, the private players are in game, right? Because rates are low, they're able to acquire capital, etc. And there's a problem here because what happens if, you know, there's no end in sight, right? Well, there's always this constant bidding. However, if rates rise and rates come in and wreck this bidding process, because now it becomes too expensive for these guys to raise capital, maybe the REITs have a chance to kind of come in and build their portfolios even more. And they're able to acquire the deals that these guys aren't able to do. And that, in a sense, actually grows their ability to grow, like what we were discussing in the model, in the valuation model. They're able to grow their rental base, and that actually is reflected into the stock price as the fundamentals actually improve. So you want to actually highlight that example. So some instances, you can have some companies, for example, that are only focused on real estate. And that's a big limitation because, you know, let's say, for example, at work, we have this kind of base company, right? So the base company, and it brings in income regardless, and it's separate from real estate. So income comes in, and we say income. And then from there, we can kind of look out and find assets like real estate, other subsidiaries, so other companies. And then stocks too, stocks. Right? So these are the things that you get an advantage of. But let's say you're in a different boat. Let's say you're working for a company that just only operates in real estate. Well, you have to then justify to the banks that, okay, where does your income come from? Well, it comes from real estate, only real estate, right? You're isolated in that boat. And you need to kind of acquire more real estate, right? So how do you do that? Well, you better hope that this real estate income is solid and that you have enough relationship with the bank to maybe borrow against this real estate and then get the nice leverage that you need. So it's a little bit of a different situation. So with that being said, when you have a REIT that's publicly traded, it has naturally more avenues, more options available, such as share issuance, right? Share issuance, bond issuance, right? So it has all these options available that maybe you don't necessarily have as a partnership or whatever, right? So this makes it a bit problematic for you, okay? And, all well and good, but that's the reason why during a liquidity crunch, you might see a delayed reaction. I still think I might end up being right, but we will see. I do think that, REITs will tend to suffer. I saw that different sectors then suffered more. We saw the industrial space actually suffer more. So if I show you, I wasn't entirely wrong. So again, Agree Realty didn't really move too much, but like, let's say PLD. Let's take PLD, for example. Let's pull up the 1 year. Okay, PLD. What happened in January? So where's January? So January, this is when I said it. It had this moment of, oh, you're right. Oh, now you're wrong. Now you're very right. Okay, and pull up Stag Industrial. All right, Stag Industrial. Let's do that 1 year. Same thing. Where's January? Oh, this one actually just went through it. It never did the recovery. But this is actually the one that we were discussing in particular. So Stag Industrial is the smaller REIT, right? And Prologis is the bigger REIT. So the market was basically saying, or probably pricing in that saying, oh, during this liquidity crunch in the beginning, when this was already very easily recognizable. I know that YouTube took a long time to recognize it for you guys. But if you guys were longtime viewers of this channel, we've been talking about it for a long time. So during this time period, you might have been like, oh, okay, so, REITs kind of bad, right? But Prologis has a lot of avenues to acquire capital, and all the smaller players are going to have a little bit more of a harder time acquiring those properties. Exactly what probably the market was thinking. And again, you go back to Stag. Stag did not like that. So Stag did not like the liquidity crunch. Okay, smaller companies like that. Let's look up another one, MPW. This is another REIT that I've mentioned in the past. Not the subject of this video. And so you see, I was right with a lot of REITs. Okay, so depending on the REIT we were talking about. So this REIT literally followed that. You can see REITs are a perfect mirror at times. And I believe that because of the nature of the business of a liquidity crunch. See, down 37% since January, which when we were making dedicated, concentrated videos on it. And by the way, that meme aged like fine wine. If you haven't seen the meme, go to the Instagram. You'll see it. You'll love it. Hopefully, if you guys follow YouTube Finance at all, you guys will love it. Let's think of another one. So I want to say, let's see, WP Carey. This one's going to be a triple net lease. I don't think this one followed it because let's take a look at this one. So let's just go on the 1 year. So January. So this one definitely wrong because this one is so diversified. It seems like not even caring. It's literally neutral. So I appeared to be right. And then the market was like, no, this one shouldn't trade down like that. But we'll see for now. Because stuff like that. And other properties like O&L. Okay, O&L. So what it turns out to be, and I think this is kind of my readjusted opinion, by the way. So December, January, it actually collapsed about 34%. So 34% down since there. My adjusted opinion is actually going to be centered on the ones that require capital, right, and don't have many options. Those are the ones that are going to feel the liquidity crunch the most. So that's my readjusted opinion, and we're always learning. So I think that that's the aforementioned technicality that I was missing before, to be very precise on which REITs would suffer more. Technically still, Realty Income is lower than what my sale price was. Agree Realty would also be lower than that, and et cetera, et cetera, et cetera. The ones I do like are some of these specialty real estate investment trusts, but we'll get to that. So the last company that we're going to talk is an honorary mention, and that is Main Street Capital. So the ticker symbol is MAIN, I believe. Yes. And so we're not going to plug this one through the model, just so everyone knows. It's just going to mention it. So this one has a dividend yield of 7.20 and a P ratio of 7.39. So it looks cheap on those bases. I want to highlight the danger, though. So take a look at this. Over the past 5 years, it's done nothing. 8.16%. And let's compare this to the SPY. Okay, and I'll explain why these tend to be pretty risky. So you can kind of see here over the past 5 years, the SPY would have outperformed of about 56.28%, while Main Street Capital is down 8.16. Quite literally, the returns would have only come from the dividend. And yeah. So what is this company? Well, this is a BDC. Okay, BDC stands for Business Development Company. Okay, what they do is they loan out to companies or they buy shares of companies. I'll do actually bonds or loans and so loans and shares. So they purchase these things from other companies. And from there, they get money in the form of repayment of loans or dividend income from those companies. You might be saying, oh my gosh, that's like Berkshire Hathaway. Nope, no. Because what they're doing, and I'll show you that when we get to the risk, is they borrow money, very similar to a REIT. That's why they're actually in this. They're in this for two reasons. They're in this for that monthly dividend income, and also because of the nature of how they actually operate is not too unsimilar to a REIT. So they borrow money. So the BDC, again, borrows money, so loan to the BDC, and then they loan it at a higher rate, like an intermediary, to a company, right? To another company. So let's say company A. Sorry, CA, company A. So in company A takes this money and hopefully invests it in a project. So project A. And then from here, hopefully this project generates company A a lot of money so that they can pay the BDC. So this is inherently much more risky. So why does this even exist? Well, this actually kind of gets to, again, if you think macro doesn't really matter, you don't understand private business at least, because the only reason why this industry even exists is because of the macroeconomic backdrop, right? Because if you had the banking system, which was very ample and liquid, loaning out to all these companies, right, in the private sector, and we've talked about this in macro videos with Werner's theories. If you had this situation occurring with, company A, B, and C, and let's say but that's the grading. Remember, let's revisit that again. In property, we have A, B, C, and on and on and on, and that determines the quality, the location. Well, this is kind of similar, I'm going to say, with company A, company B, company C. Company A is great, company B is not as good, and company C is not as good as B. So in the banking system currently, we don't lend to B and we don't lend to C. We just lend to A, right, as an example. Or maybe we lend to A and B, but not C. So C still needs money, right? So C still needs money. But how does C get money if the banks don't give C money? Well, the C is going to go to these BDCs. These BDCs are going to say, hey, there's an opportunity here. Maybe we can find some of these seed companies and we can loan to them and then get an excess return. Now, there's a ton of BDC companies. Main Street Capital is one of the more successful ones. And that's to say something that even they haven't outperformed the market. But if we actually take a look at other BDCs, they're not going to be so good. So remember, let's take a look at Main Street Capital here. You can see that they're, again, when did they IPO? Oh, right, around the financial crisis. Convenient, because this was actually the best time for BDCs to formulate, because then there was a lot of business. Again, because we're back to this situation where under the macroeconomic backdrop, you get a lot of lacking in lending in the banking system, which then gives opportunity to the BDCs, right? So BDCs get all this ample opportunity and they can lend out, these companies that they're investing in, they're the rejects. So you got to understand that. They're the rejects of the banks and other companies. So rejects. These are companies that we probably would never buy, not in a million years, but we would never buy or wouldn't be worth it for us. And so they're high risk. So that's kind of reflected in the stock price of these BDCs, such as Main Street Capital. You're getting that 7.20%, but that's not free of risk. That's actually quite a bit of risk that you're taking on. And so with that all kind of, summarizing it all together, I want to then bring you to the actual parts of, let's actually just bring you to the income statement. And I want to take you to Main Street Capital's website, and I'll walk you through how we actually find all that. So here we go. Let's go here. Main Street Capital, open link, new tab. Let's go here. So portfolio of companies, just want to show you this. You probably never heard of any of these companies. These are some of the companies that they own or have lent money to. So you probably never heard of most of these companies. You can go there yourself and kind of explore it, but it's a lot of companies. You're saying, look, they're so diversified. They're so amazingly diversified. Okay, so yeah, that's what a BDC does. And let's go down to investors. Where are you at, investors? There it is. All right, so we want to go to financial SEC filings. SEC filings, we're going to go to annual filings, annual reports, 10K, and PDF. And then from here, we're going to go here. We're going to go to the financial statements, consolidated financial statements, and we're going to go down. We're going to go here. We're going to zoom in for you mobile users or you old people. I'm just kidding. I love you old people. All right, so assets, you can kind of see it's very structured really similarly. Control investments, affiliate investments, non-controlling / affiliate investments. Very similar to how the REITs are organized. So you have the totality of the investments, 3.5 billion. Cash is not really that much. We want to see all these notes. So 3%, 5.2%, 5.4% due in 2022. And again, these are due 2022, 2024, 2026. Okay, so yes. In totality, you can see exactly how much is owed by these, and these went into there along with share dilution, because they probably also diluted shares. They're not really going to buy back shares again, because they're going to look at how they can, structure their cost of capital. Looking down here at the income, you can see interest income, control, affiliate, non-control, total investment income, $289 million. And then we have expenses, interest on the debt, compensation for the deals occurred, general administrative, share-based compensation, all that jazz, blah, 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 blah. Net realized gain, control investments, affiliate investments. So realized gains, by the way, so they actually sold these, or these are done. And then unrealized gains, these are not to be sold yet. But in totality, you have $135 million and $45 million in realized gains. So from there, they probably reinvested this back. So total net income of $330 million. We go to the statement of cash flows. This is actually right here, a public offering of common stock. So they're consistently issuing shares to raise capital. Net increases in assets, about $330 million. This comes from the totality of, and we go back to the income statement. You might be saying, well, that's weird. Why are they calling it that? Yeah, you're right. So where is it? Yeah, right here. So net increase and decrease in net assets resulting from operations. This is akin to the net income, basically. So when you see this, you think net income. And then cash flows from operations is going to be negative. The reason why is because the line item, including investment in portfolio companies, indicates a negative $1.7 billion. So that they're investing $1.7 billion back into their investments or into other investments that they're finding. And yes, so dividends paid is about $160 million. So in totality, you have, I would look at this and compare it to this. So the net increase in assets is $330 million. They're going to pay you out of that equity about $160 million. And if you never heard of a BDC, congratulations. I don't know if another YouTuber talks about BDCs, but yeah, they're a unique little asset class. I'm not going to get into it because it's not really like a course on BDCs, but they're a little interesting, but not what the average person should really be even thinking about, in my personal opinion. The average person should not be really even considering these as investments. But yeah, they exist. They have a little interesting accounting nooks and crannies. But I think that's where I'm going to kind of leave things off, and because it's already at an hour, exactly at the point. By the way, for some context, I want to add, maybe you guys can laugh at this. If you made it to the end of this video, you guys are definitely not goldfish. So applause for you guys. Let me move the mic. So applause for you. You are not the goldfish of the internet. You guys can actually watch an entire video that's an hour long. Maybe I don't want to fault you if you have work or something or kids and you can't watch an hour-long video. Don't worry about that. But if you guys watched the whole video, congratulations. And hopefully you found value in this video. Feel free to leave a like, comment for questions, stuff like that. On that note, these videos, I do enjoy doing them, these longer videos, and this covers a bunch of requests that kind of came in. All of them had something similar in common, so I kind of got them all out of the way. In summary, to summarize them all, remember the risks associated with all of these businesses. If the cost of capital rises to a huge degree, let's pull us back to the whiteboard. So one commencement whiteboard moment. Cost of capital rises. All right, so cost rises. This hurts their ability to grow. So growth actually will decline for a lot of these entities, because it hurts their ability to find deals. So deals become more scarce and maybe a little bit more, it's just harder for them to come by. And then there can be a slight or medium-term separation between the ability for these companies to acquire at the cost of capital versus the cap rates. The cap rates might be a little bit too high for a moment in time because the sellers haven't reacted yet. So it just depends. And then that might be opportunity for some private entities that, have some income coming in, and they're separate from that. They can probably take advantage of that, but regardless. All right, so on that note, guys, thank you guys so much for watching. Again, if you aren't subscribed and you enjoyed this video and you found a lot of value here, feel free to subscribe, like the video, share it with your friends if you find anyone that's really interested in these kinds of topics. I know it's a deep video, and of course there'll be chapters. Well, you guys have already seen the video, but there have been chapters, so it should be a little bit manageable. But again, I'll see you guys in the next one. Bye.